Hey, so today I'm going to look at a question that many of you probably don't think about very much, which is where is all the inflation? So, in a normal functioning economy, at least under the normal models, the idea is that lots of economic competition, particularly for labor, will lead to people moving jobs. And as they move jobs, they get higher wages. And those higher wages reduce firms' profits, so they have to pass those higher wage costs on to consumers, which will raise prices. Higher prices mean more competition for labor, which means more wages. So, like for example, if you go to Walmart and everything's more expensive, the wage that you get for your current job is going to start to feel unsatisfactory. You'll start to look for new work. That cycle of economic activity can become problematic if inflation starts to get too high. And if that happens, the Federal Reserve exists to raise interest rates and lower economic activity. So literally just sort of like take away the punch bowl is the story. Um, for the last 20 years, and certainly since the '07, '08 crisis, there hasn't been any real inflation in the United States. Interest rates are at as basically as low as they can get. There are economies around the world where federal set interest rates, government set interest rates are actually less than zero, and that is still not boosting inflation. Inflation is probably a good thing because it means that if I buy a house, the inflation is going to start to lower the value of that principal over time. So if it was 300,000 10 years ago, inflation means that the real value of that principal has been going down 2% every year for the last 10 years, which gives me a little bit of a buffer. If I over borrowed over time, the value is going to start to go down and it's going to give me a little bit more of a cushion. The bad side of that, if inflation were negative, that's called deflation. That would mean that the actual cost of that loan is going up over time. At the same time, I could expect that my wages are going down, and you kind of get in this really vicious cycle. This is what happened in Japan in the 90s and 2000s when they had this cycle of deflation. So this is the thing the Federal Reserve exists to try to panically avoid. The challenge has been that the normal tools we use to try to get at it, which is really low interest rates and other forms of monetary easing, have not been increasing inflation in the rate that we want. It's pretty common to hear that low employment drives up inflation, but even when we had super high employment, over the last 4 years with the Trump administration, there's been tremendously high annual deficits. That equates basically to economic stimulus. So there's been this Keynesian moment for the last 4 years where the government's been pouring money into the economy, and that took the form, by the way, of big tax cuts, and that has led to big increases in employment, which has been great, but it hasn't led to big movements in inflation, and it hasn't led to a lot of upward movement on interest rates. So inflation has been low, interest rates have also been sort of low, and employment has been high. The idea being that you're supposed to kind of tamp down, and you can sort of see this follows something called the Phillips curve, and the idea is that as the curve moves, you're supposed to start to see a relationship between employment and inflation, and you just don't. So one theory about where it went has been that it's because of all the savings in the United States. And everybody who has a salary job will often have a retirement account as well. And so that retirement is savings. It's termed as investment, but it's really just savings in sort of a weird savings instrument, which is the stock market. So these 401ks that you would get, you buy securities with that. That money is not actually going to the companies that you're investing in. It's swimming around in the stock market. So what you get is sort of high risk, high return savings accounts. And that savings account glut has driven up the value of all assets across the board. Like wine is exceptionally high right now. Art is exceptionally high right now. Stocks and bonds, of course, are also high. Those two have been moving together, and they typically don't ever move together. The old story was that stocks and bonds were supposed to move inversely to one another, and that hasn't happened. Um, it's so cheap to borrow that price increases really don't show up for the consumer because they can borrow with such a low interest rate. You're not getting this sort of sticker shock. The other premise is that maybe the numbers and how we calculate inflation are wrong. One story about why inflation has been so low is that we import so much from China. Chinese trade behavior has been to try to keep the currencies from adjusting to that big trade imbalance by buying up U.S. corporate and government debt over the last 20 years with that big trade surplus they've got. That has kept the currencies more or less in balance. Now, that might be changing. The dollar's been on sort of a 9-month nosedive, but at the same time, we haven't seen big increases in interest rates, which would suggest an increase in inflation expectations. The calculations may also be wrong. So housing in the United States is pretty expensive, and it could be that because we don't include the cost of housing in the inflation numbers, we're not capturing actually the day-to-day expenses for a normal individual. We pay very close attention to cost increases in milk and cell phones and other such things, which are kind of hard to value from one year to the next. But housing doesn't show up in there, and those increases actually have been pretty substantial. And there's also very considerable regional variation in inflation. Some cities, San Francisco, for example, prices are outrageously high, even for very, very basic goods, whereas in Mississippi, those same basic goods might be 3/4 as much, 60% as much. And that change from year to year, but also that change across region, it's very hard to calculate and capture. So the inflation number that we're seeing may not be really weighted appropriately. So how much should we count the cost of eggs in San Francisco against the cost of eggs in Mississippi? They try to do it based on value, but that's really a hard calculation to get at. Anyway, so inflation's kind of missing. Nobody really knows what happened to it. The hope is that it comes back and people can start to understand again what's going on with the economy. But while inflation remains low and unemployment remains high, you're not going to start to see it come back anytime soon.